Debate continues. On the one side is a flow of money from Asia, invested by reserve managers from countries running current account surpluses. That's the red arrow into the long end of the US Treasury curve. On the other side, the blue arrow shows the flow of money from European banks into mortgage-backed securities at the short end of the yield curve. Two strands of evidence support the European banking glut story. First, the evolution of the US bond market itself shows very much the imprint of European bank demand. And second, the European investor portfolio of US bonds shifted in a way consistent with the banking glut story. In particular, you can see in the graph that in 2002, European investors had a portfolio of US bonds quite similar to that of US investors. Move forward to 2007, though, they had changed their portfolio in the direction of more risk, asset-backed securities, US corporate bonds. And that was on a residency basis. On a nationality basis, the shift in risk was even more extreme. Nationality matters because European banks were not just hapless investors in complicated securities. They were producing them as well. In particular, they had big securities operations in the United States. For example, RBS had an affiliate in Greenwich, Connecticut that was #1 in the underwriting of subprime mortgage-backed securities. Far from it, Ireland and Spain experienced relatively larger inflows of bank funding, experienced even larger run-ups in property prices, and experienced even larger increases in domestic credit. No one thinks these had anything to do with the Asian savings glut. Instead, the fingerprints of European banks are all over these cases.